Making millions in the stock market. It's almost never about luck. It's really not. You're not going to find some magical hidden stock, and you are definitely not getting rich overnight. Real wealth? It's built through absolute discipline, patience, consistency, making the smart choice over and over again. In this explainer, we're going to break down exactly how you build that wealth from absolute scratch. Let's get right into it.
So, how can I double my money fast? Man, that is the exact dangerous question almost every beginner asks when they first open an account. And hey, it's a super tempting thought, right? But the second you start asking that, you're literally setting yourself up for failure. That mindset pushes people to chase wild promises. Instead of investing, they're basically just gambling their hard-earned cash on whatever the internet is hyping up that day. When you're desperate for fast cash, you fall right into a trap. You chase viral stocks, social media hype, the whole risky speculation game. That's the amateur gambler mindset, hoping some random meme stock buys you a yacht by Tuesday. Smart investors, they rely on discipline, patience, and consistency. I know, that sounds incredibly boring compared to a stock rocketing to the moon. But here's the secret. Real investing usually looks boring, and boring can become wildly profitable. Wealth comes from long-term thinking, not short-term excitement. Okay, let's dive into this. We're taking a 4-part journey today. First, the wealth mindset. Second, building the foundation. Third, strategies for growth. And finally, mastering your emotions. Starting right off with part 1, the wealth mindset. It's all about thinking like an owner. To build this mindset, we really have to redefine what a stock actually is. It's not just some random ticker symbol bouncing around on your screen. It represents fractional ownership in a living, breathing business. When you buy a stock, you are buying a tiny piece of that specific company. If you can make that mental shift, that you're an actual business owner, you instantly separate yourself from all those emotional traders sweating over every little dip on a line chart.
Because if you don't make that shift, well, you're going to pay for it. There's a famous saying in finance: the market charges high tuition fees for bad decisions. If you just dive in blindly without learning the basic concepts first, you're setting yourself up for a very, very expensive education. Seriously, investing without knowledge is a surefire way to hand your money over to the people who did take the time to learn. Which brings us perfectly to part 2, building the foundation. This is how you start smart. Now, what's really interesting about this is what you don't see. You do not need a finance degree. You don't need to be a Wall Street whiz to start investing. You just need to grasp these simple basics: how markets work, why prices move, how companies actually make their money, reading basic financial statements, and managing your risk. That's your foundation right there. Once you've got that baseline, a lot of folks freeze up. They think, well, I just don't have enough money to start yet. But starting small is actually the smartest move you can make. Your first investments aren't about making millions. Sorry to burst that bubble. They're about building the habit. They're for learning how you react when your money goes up and down, feeling out market behavior, and getting real-world experience without risking the farm. All right, part 3, strategies for growth. This is the power of boring. This growth strategy is basically an incredibly simple, repeating loop. Step 1, start small, like we just said. Step 2, invest regularly. Month after month, year after year, consistency is literally the biggest secret to long-term wealth. You don't need perfect timing, you just need to be perfectly consistent. And step 3, let compounding work. Because you're consistent, your money makes money, and then that new money makes even more money. It's a snowball effect doing all the heavy lifting for you. And this brilliantly illustrates exactly what to look for when you're deciding where to put that consistent cash. The contrast is night and day. Viral stocks are driven by pure speculation, focused on the short term, and result in insane risk. But quality companies, the ones you actually want to hold on to, they're driven by strong revenue and healthy profits. They focus on the long term, and the result is massive wealth creation. Great businesses just survive market chaos better than hype ever could. But to make that happen, you need the ultimate advantage: time. Real wealth isn't built in weeks. It's not built in months. It's built over years and decades. Millionaires who made their fortunes in stocks didn't get there by day trading in and out every 20 minutes. They got wealthy because they stayed put long enough for compounding to actually do its magic. Moving to our final section, part 4, mastering your emotions. This is all about surviving the noise. Because let's be real, the stock market is exhausting. Every single day you are absolutely bombarded. Analysts making wild predictions, breaking news alerts flashing red, sudden market panic, irrational excitement, and an endless sea of opinions on social media. If you react emotionally to every single piece of that noise, you will destroy your portfolio. Honestly, one of the greatest investing skills you can ever learn is simply knowing when not to react. And learning not to react is absolutely vital when things look bad. Here's a thought for you. Market crashes create opportunity. Let that sink in for a second. I know it sounds completely backwards when you're a beginner, but experienced investors, they don't always fear the crash. Here's how that actually plays out in reality. When a crash happens, fear spreads like wildfire. Because of that blind panic, those strong, quality companies we talked about earlier, they suddenly trade at way lower prices. The underlying business is still fantastic, but the stock price is just cheap. That's the exact moment long-term investors step in. They look at market fear as a chance to buy incredible businesses on sale. They aren't buying everything, but they definitely know a good discount when they see one. Now, right there is the stark difference between emotional trading and emotional control. Look, emotions destroy way more portfolios than a lack of intelligence ever will. When people get emotional, they panic sell at the absolute bottom, they chase hype at the top, they get greedy, and they get horribly impatient. Successful investors, they practice emotional control. They follow their systems, they stay fiercely disciplined, and they keep their eyes locked on the long game. So the crucial point is that this whole journey really boils down to these core pillars. Learn the basics before you jump in. Start small, build your experience, and invest with absolute consistency. Focus your cash on high-quality companies, ignore the exhausting market hype, stay patient through all the noise, and let the math of compounding do its thing over the decades. It's not flashy, it's not going to go viral, but I promise you, it is incredibly powerful. So I want to leave you with one final provocative question. Will you focus on becoming richer immediately or becoming smarter consistently? Because if you truly want to build wealth, the stock market isn't a magic ATM, and it's definitely not a casino. But historically, patient, disciplined investors give themselves an amazing shot at completely changing their financial futures. The millions don't come from one lucky moment. They come from years of good, smart decisions repeated over time. Thanks for hanging out with me for this explainer. Keep building those smart habits, and I'll catch you in the next one.